1, 2, 2. Are we good?
Yep.
Okay, great. Hey everyone, great to be here. I'm Marco. I'm one of the founders of Tapir protocol, which is a DeFi production marketplace, as you can see, and we are trying to make DeFi safe or SAFU, as we say in DeFi. A little bit about me. As I've said, Tapir protocol. I also have been working as a researcher for token dynamics and a data analyst. Have been involved with staking protocols like DIVA and SSV in the past. You may have seen some people from SSV here. But we don't have much time, so let's get into it. So let's start with some questions here. Who is a DeFi user? Who has used DeFi? Anytime. Okay, good. What about a user on a regular basis, every month? Great. Have you heard any DeFi about any hacks? In general, DeFi hacks? Okay, great. I think there is no one in crypto who has not. And are you afraid when playing with DeFi protocols of losing some funds? Sometimes. All the time. Okay, I think we all kind of have similar problems here. And we here in this room are similar to what most people or most investors are like. Most investors are basically in this middle group and are looking for good yields with low risks. You can think of staking, lending markets who have been established for years as this time, like AVA and stuff. Then we have like super conservative investors who basically are hodling in cold storage. And then we have the rest of DeFi, which it is famous for, are the degens. You know, just give me 200, 300% yield and be done with it. I don't care about risk, okay? So, but as I've said, as the DeFi matures more and more, most people are in the middle category, and which includes me as well. Basically, we want good yields with very low risk. We understand there is some risk. It's not like hodling something in the cold storage in the vault, but we want this risk to be reasonable. So, and this is the kind of the problem or the opportunity we see and we are solving with DeFi is basically bringing the yields that normally only the degens get in like high risk, high yield products like Athena, Pendle, and others, and de-risking these yields and offering them to basically everyone else. So, as I've tried to show with these arrows, we are de-risking the high yield stuff, high risk stuff, and basically keeping the yield but removing the risk. So how does this work? That sounds like magic, right? So let's try to see how that works. As I said in the beginning, we are a marketplace, a DeFi protection marketplace. So what does that mean? That means we always have two parties, let's say Sean and Bob, and one is selling the risk protection. Sean here, he earns extra yield on top, and Bob wants to protect himself, and he's buying the protection. Okay, what are they buying the protection on? As I mentioned before, high yield assets, high yield degen assets in DeFi, such as Pendle assets. They offer high yield, but they bring the high risk. And basically, bringing the yield from these protocols into Tapir, we can then basically allow people to buy or sell risks. So an example would be Bob's buy DP as USD or USDE, which is like a DeFi protected asset of Pendle's Athena USDE, and basically he's not getting 14%, but he's only getting 11%, let's say. Sean is getting the additional 3%, as I show it here on the other slide. Yeah, I think here it's much better visible. So we have some really nice yield. This is like a realistic yield, which you can see on Pendle regularly. around 14% for the stables, which is very good, obviously, but it's quite risky. And as I said, we have Sean and Bob. So we can see the regular yield in the purple in the middle. Sean is basically, he knows the risks. He's either a degen or he's somebody who is good at risk management, knows the risks of the underlying protocols, and he's ready to provide the protection for these. So, and this is kind of the magic of the situation. One is able to get a higher yield, but most of us are kind of in the Bob's example, or I mean that's my assumption, but maybe not most of us, but for Bob it's still great because he's not getting the full 14%, he's getting 11%. But if you compare it to other like lower risk investments like Aave and stuff, it's still much better. There you can get around like 4%. So let's move quickly here. Basically after I've already talked how it works, so I'll just talk about like the second bubble. The important thing here is that the marketplace here is perfectly capital efficient. It's perfectly capital efficient in the sense that the yield is not lost, neither for the protection buyer nor for the protection seller. Basically, they are both getting the yield, the high yield of the DeFi, the high yield of the underlying, and they are just trading some of the premium with each other. And this is another great thing. The price of the DeFi protection is fully determined by the market, so there is no need for Tapir protocol to basically do any kind of risk analysis, trying to price the asset, because Tapir itself is just helping to facilitate people buying and selling risk. It's not taking the position itself. Even in case if some of the buy or sell offers in the market phrase are not fulfilled immediately, the base risk of the underlying is still incoming. Okay. Also, let's try to look at the competition or at the landscape. The main competition and the main market leader in this segment, what has been tried and what has been done so far, is Nexus Mutual, which is a very nice project, but it has some flaws. It's basically a different take to this. It looks more like a traditional insurance business. Basically, they have like a risk assessment teams, and they are taking on the risks themselves. I would argue there are a couple of things which are kind of problematic and that we see could be improved and could be done differently. Basically, the last one. Users, if they want to, they can't really buy like a protected asset that is already carrying with itself the yield. They need to buy the asset somewhere and then buy the protection elsewhere. And even when they buy the protection, they kind of need to read the fine print, like what is the protection covering, what it is not covering, and basically if the thing is going to be covered in the end, it's up to the Nexus Mutual governance, like if they feel that it fulfilled the criteria. In comparison, in Tapir, this is not really the case because we are dealing with the assets that have some base underlying oracle, and this process of determining if defect happened is fully automatic. As I've said, I already talked about these points, and I want to leave some room for questions. Anyone?
He was first. Okay, so how do you design the marketplace, or like the smart contracts that govern how to buy and sell the risk?
Okay, so there are two things I think I actually have a slide for that as well, but I know I don't have much time, so let me see if I have a specific slide for that. Okay, here. So you can kind of read the first one. Basically what happens, you have two modules. One module is taking the base yield. So let's have an example. You want to buy like a defect protected asset, right? What happens in the background is there is some base asset. There is like Pendle SUSDE that brings 14% fixed yield. What happens in the background is like this asset is bought from Pendle. It's kept in the vault, and against this asset there are like two assets minted. There is the DP and YB asset, and DP is the part which is carrying the defect protection. YB is the part that is basically providing the protection. What happens is if you buy like 10 tokens, 5 you will get from the system from this split. 5 tokens of the defect protected asset and 5 tokens of the yield boosted asset. And it's basically the same position. If you just keep holding both of these tokens, it is as if nothing happened, right? So it's kind of a neutral thing. Then what happens in the background is if you just want a defect protected asset, automatically the yield boosted asset is sold into the pool, or limit order is set, which is selling basically the yield boosted part for the defect protected part. And the price determines basically your like how much you are paying or are getting paid for the YB or DP asset.
Okay, clear. Thanks.
I have a question like how big is the protection, or how's the protection works? Let's say there's DPEG, like we lose like 10% value, 15% value.
Okay, so how does that work if you basically buy or sell? Okay, so let's have an example when we actually lose some value. Anyway, here you can see a bit of the front end, how it looks, and I just want to point out that we are really going for the simplicity here. You are just on the front end buying different types of assets. You have like the stable coins, you have the base yield, the defect protected one, which you can see it's a little bit lower than the base, and yield boosted one, which is a little bit higher than that. Then you are asking, okay, what happens if you have 10% DPEG? You can think of it very easily is somebody, let's say I sold you the protection and you bought it. You have the DP asset, I have the yield boosting asset. That means if there is 10% DPEG after in the period for which is valid, then at the end of the period, I basically take on 20% loss. I take 10% loss for myself, basically as if I was just holding the base asset. There is a 10% loss, and normally you would be having 10% loss as well, but because I need to cover your loss as well, I will experience 20% loss and you will get no loss. So that's how it works. For some of you, like it may be clear, this is not for free, and obviously, like if the DPEG is too big, if it's more than 50%, it will not cover you 100%, right? But this is kind of we feel that this is a good trade-off for getting like the full capital efficiency that we can get. Because when we get full coverage, or there cannot be any time bad debt in the system, because everything is covered one-to-one. Unlike with Nexus or like traditional companies like this, where they are just underwriting something and you don't know how much balance do they have against these assets they are covering. Here the assets are covered one-to-one, but because they are covered one-to-one and we want it to be capital efficient, there is this kind of a trade-off which we feel is worth it. So
the funds or whatever is insured and whoever sold the insurance and also the body, both funds are held in the vault until the end of the term.
Exactly.
Okay.
Yes.
Okay, so that's how you can,
Yeah, you have like you can think about it, you have a 3 month term, there is a resolution.
Okay.
Okay, perfect. Anyone else?
Is it only for stablecoins or do you do other things?
No, we are thinking about it. What makes most sense here, it's to have it for like the major assets, which would be stables, like ETH-based assets and Bitcoin-based assets. Yeah, those would be like the 3 main categories.
And you decide which assets are listed?
Yeah, we kind of, I mean, in the beginning, obviously this can be, in the future we would like this to be doable by everyone, but we would decide which is listed on the front end. We would love, someone else to kind of start the markets, because as you can see, there is no, basically, we are not doing any strategic decisions here. We are just, what is the main thing that we are doing, we are kind of kickstarting it. We are choosing which assets do make sense, and basically that's about it. But we would love in the future to open it to anyone who can do this. The kind of the only thing that why it doesn't make sense to have all the markets right away is the liquidity. Obviously, like if you just want to have the DPEG protection, you need to sell the yield boosted part to someone, right? So you need to source the liquidity from somewhere, and this is obviously not so easy in the beginning, at least.
I think we're at time.
Okay. Okay.
Thank you.
Perfect. Thank you.